Good morning. Hopefully everybody can hear us and see myself and Michael Dow, our Chief Investment Officer. I'm going to spend just 2 minutes introducing him, and then I'm going to go off as well, and we're going to focus on Michael and the remarks he has prepared, as well as some questions from all of you. So thank you for joining us, for joining Julia and I and Michael. So Michael is our Chief Investment Officer at Beacon Pointe. He is very involved in client portfolios, portfolio strategy. He also is the pen behind the written client pieces that you sometimes will find in your email inboxes, and that we highly recommend that you have a look at, hopefully relevant to you and to the investment landscape we're in and the portfolios that we're managing for all of you, our clients. Michael is also the chairman of our investment committee. He has all the letters beside his name you could ever want: the Chartered Financial Analyst, CFA. He is an inactive CPA or accountant, has his accountancy license. Prior to Beacon Pointe, he was a managing director and ran several different divisions at UBS, a portfolio manager at PIMCO, has just an extensive amount of experience. He's seen a lot on the front lines of investing and been through many market cycles. So we think you'll enjoy hearing from him today, and hopefully this is helpful for all of you out there. Please don't hesitate to contact Julia and myself with any questions, but I'm going to let Michael go ahead, take it away.
Thanks very much, Indy. I appreciate that. And thank you very much for joining us on the call today. Today's webinar is entitled Investment Insights: How Coronavirus Has Impacted the Markets. What I hope to do in the next 30 to 35 minutes is to give you a sense of what it is that we're thinking about here at Beacon Pointe in a world of what I would consider to be incredible, radical uncertainty. Having a framework for trying to understand what's happening in the world and perhaps some perspective and a little bit of background, I think is incredibly useful when deciding what to do as investors. So with that, I'll jump right in. I'll start by talking about what the game plan is for the pandemic. We're in uncharted territory here. This is the first ever recession we've had that was instigated actually by the government, a recession by government decree. So where we go from here, we have to have a healthy dose of skepticism and a little bit of humbleness as we navigate what has been a pretty extraordinary response to a pretty extraordinary recessionary environment. We're going to talk a lot about what's happened in capital markets. What has the equity market done? What has the fixed income market response been to the sudden stop in the U.S. economy, and highlight some opportunities and frankly risks that we see going forward. What's been the government's response? I can't find a superlative to describe how the Federal Reserve has done, and the fiscal response has also been just absolutely unprecedented. It's an unprecedented response to an unprecedented slowdown in activity. This is going to go on record here in the second quarter of 2020 as being the deepest economic slowdown, not just in the post-World War II history, but in, frankly, U.S. recorded history. The response has been just as unprecedented and massive, and we'll talk a little bit about that in a moment. This isn't, however, completely new territory. The speed of the slowdown and, frankly, the swiftness of the government's response is unprecedented. But there are a lot of echoes of what we saw in 2008, 2009. At that time, as India mentioned, I was actually managing bond portfolios and saw firsthand what the implications were of a liquidity crisis, a revulsion in credit, and a sudden stop in the provision of lending and credit in the corporate bond market, both here in the US and globally. So I want to try and bring some perspective to what we're seeing currently by comparing it to 2008 and 2009, both the actual implications and, frankly, the response from the government. More importantly, where do we go from here? How do we get the economy reopened? And what does it mean for portfolios? And I'd like to share with you a few thoughts. Let's start with the game plan for the pandemic. It's not that hard. First things first, we've got to see a reduction in the new cases. And everyone's talking about bending the curve. All that means is lower new cases, lower hospitalizations, fewer people getting sick, is the prerequisite to moving on to the next step, which in our view is adding up the economic damage of the containment measures. It's been necessary to shut down the economy. It's going to cost us in terms of economic growth. How much is that economic growth? We don't know. We'll figure it out in the next coming quarters. But in the meantime, there's the positive. And the positive side is government's mitigation efforts have been pretty meaningful. We'll talk about those. So the idea that you can first fix the virus issues, that is, you've got to contain the new cases of the virus, then you can add up the economic damage, and then you can see what the government's mitigation efforts are doing. And the net effect of those two things is what will determine the course of risk assets going forward. In the meantime, there's a lot going on in credit markets. So we want to make sure that we're keeping an eye on credit conditions and see that there's a reduction in equity market volatility. So let's talk about the S&P real quick. Here's a chart of the S&P 500 going back to December 2018 at the low. We're up 45, almost 44%, a little over 44% from the lows of December 2018. And then we had the fall beginning on February 23rd until the nadir, the trough of the graph here is March 23rd. So in just the span of a month, it dropped 33%. Since then, in large part because of the government's mitigation efforts, we've had a nice little 25% rally. The chart on the bottom is VIX index. That's the equity market volatility, very important. And you'll note that when volatility peaks, that's typically when the market starts to turn around. So we keep a close eye on the volatility index. It is declining at the same time that the equity market is recovering, something that we're focusing on going forward. Just to tell you how extraordinary the last 4 weeks of S&P trading has been, I just want to show you the daily market movements for the 8 months prior to March of 2020. Here are daily price movements, and they generally fall within 1 or 2% plus or minus on a daily basis. By the way, the scaling of this chart here is exactly the same as the scaling of this chart. On the left side, August 2019 to February 23rd. On the right side, this is the S&P 500 daily price movement since February 24th. It's been extraordinary. It's a period of time and a period of equity market volatility that we haven't seen. Very unusual, requires some analysis and some understanding of what it means. The good news is it appears that the equity volatility peak may have been at the last week of March. Since then, we've started to see at least some measure of reduced volatility in the marketplace. And again, that's attributable to the Federal Reserve. Here's the VIX index. It's the equity market volatility index. I'll just mention that it was at an extreme level again, March 23rd. It's come down considerably since then. We can take comfort from that. That the Federal Reserve is doing what they can to reduce equity market volatility, which over time will start to make us as investors feel better about re-entering risk assets. It's not just the equity market that's been under some stress. And one of the things that we're looking at to see whether there's some healing and a recovery in our future is in the credit markets. This is the investment grade corporate bond spread. It's the spread of what a corporate bond's yield over and above a U.S. Treasury. You can see back in 2008 that it peaked pretty considerably and has come down since 2008. Almost on a straight line with a couple of hiccups between now and then. Nothing, though, since the great financial crisis, we've seen nothing like it here when credit spreads peak. So seeing the credit spreads here in investment grade corporates peak at this level and then come down, that is clearly a function of some of the Federal Reserve's programs to provide liquidity and credit funding vehicles, the alphabet soup that you've heard about, TALF and SMCP and PMCCP and all the other letters that the Federal Reserve hasn't just invented this time, but frankly, they invented back here in 2008 and 2009. These credit and lending facilities are going a long way towards soothing the cracks in the credit provision here in the United States, and that's absolutely essential. You need to have a functioning credit financial system. That is, you need a functioning bond market in order to have a functioning economy. Without a functioning bond market, the stock market would decline dramatically. You need to be able to fund businesses and households. And in fact, you need to fund the government. So if the bond market shuts down, everything shuts down. So everything the Federal Reserve has done for the last 4 weeks has been to fix the bond market. And in fact, every single program that they've developed is effectively nationalizing a corner of the bond market that saw stress or that had cracks appearing. They've done that very effectively. They've effectively nationalized all the credit markets that are of interest to investors, both here and of interest to investors outside the United States as well. The only capital market that they haven't nationalized just yet, when I mean nationalized, haven't bought, haven't created a program to lend to or to purchase directly like treasuries and mortgages, is the equity market. And they will do that, and they have that ability through emergency powers at the Federal Reserve to buy equities. I'm not suggesting that they will, but should we see a return to some of the low levels of equity market lows that we saw in March, it's not entirely clear to me that we wouldn't see the Federal Reserve going out and buying equities in the open market through ETFs. So they're doing a great job. They're doing what they're supposed to do, and it's a playbook that we're all familiar with. I wrote a piece back at the end of March when the Fed began cut rates and cut rates to zero, expanded their balance sheet, opened up some repo market operations, and frankly provided the exact recipe of both policy and rhetoric to soothe the capital markets. All of these credit facilities are just the culmination of the Federal Reserve's ability to get out there and to fix what's broken in the bond market so that the rest of the economy can start to heal. I wrote that on March 24th, and frankly, the cavalry continues to arrive. They've done all of this to date, and in fact added more on April 9th last week to some of the programs that they've already got up and running to actually expand the types of securities that can be funded through the Fed and through the US Treasury to include extraordinarily high yield bonds, which is something we haven't seen before. So that would be new versus 2008 and 2009. The Fed didn't need or feel the need to purchase high yield bonds back in 2008, but they did this time, and it's caused a spectacular rally. Just to be clear, the recovery in the equity markets and the tightening of corporate bond spreads are directly linked. There's no way you can separate the recovery in capital markets from all of these funding vehicles that the Federal Reserve has brought to bear. It was a function of looking back March 8th, 9th, 10th, 11th, and understanding that we were going to have an economic slowdown, understanding that that was going to lead to a credit crunch, and that the Fed, they knew what to do. We knew they knew what to do. It was just a question of how quickly would they bring all of these facilities to bear. How quickly would they take interest rates to zero? Pretty quickly. How quickly would they expand the balance sheet from 4 trillion to 6 trillion? Faster than ever. How quickly would they reinstitute the PDCF, MMLF, and create new facilities like primary market corporate credit facility and the secondary market corporate credit facility? The answer is in record time. It's going to be, they're going to write academic papers about how quickly the Federal Reserve responded in this instance, and it's been reflected in increasing health of the bond market, reduced stress and volatility in both the bond and the equity market, and all of that is going to contribute to a reduction in the damage done to the economy once we finally reopen. What does the Federal Reserve balance sheet look like today? So I mentioned that quantitative easing is when you expand the balance sheet by buying treasuries and mortgage-backed securities. It's one of the Fed's most effective tools to reduce stress in rates markets. When I mean rates markets, I mean at the U.S. Treasury yields and mortgage-backed securities yields. Lower mortgage-backed securities yield means it's easier to get a mortgage. Lower Treasury yields means all interest rates across the economy are lower. On the left-hand side is the Fed's balance sheet through the great financial crisis. You saw a massive expansion from 2013 until 2015 when the Fed's balance sheet peaked at 4.5 trillion. The orange line, by the way, not coincidentally, is the S&P 500 index. So with an expansion of the Fed's balance sheet, you can see it's a highly correlated trend that the equity market followed. So that's good evidence that the Federal Reserve's ability to provide liquidity through a quantitative easing or through the expansion of their balance sheet has been very beneficial. That liquidity has to flow somewhere. It's like the Fed's printing money and pushing it out into the marketplace. By pushing money into the marketplace, you have to buy something, and a lot of folks decided to buy equities. So that's what we saw. It was the Fed's unstated intention to increase equities over the course of 2013 until 2018 in order to provide support for the U.S. economy through the wealth effect and through other beneficial financial transmission channels. What are we seeing now? So this is the Fed's balance sheet going from January 2018 until today. So the Fed tried to reduce the size of the balance sheet. That increased volatility in the equity markets. But when the COVID crisis hit and the sudden stop in the U.S. economy was apparent, the Fed immediately reversed course. These charts, by the way, are not on the same scale. If they were, the current level of the Fed's balance sheet would be at the very top of this page and probably off of this page. So I've included the second chart here to suggest that the cavalry arrived. The Fed QE program ramped up pretty meaningfully and pretty swiftly, and now you've got about $6 trillion on the Fed's balance sheet. It seems remarkable. And it seems remarkable that we would be able, and as a country in a position, to expand the balance sheet to this degree. It is. And I'll talk about the potential for longer-term consequences in a second. The issue that we face here now today, given the sudden stop in U.S. activity, can't fully be repaired with monetary policy alone. So the federal government has to have a fiscal stimulus plan ready. And they did. It's absolutely amazing what the Fed is, or what the fiscal authorities have done. Beginning on March 6th with a very small, and in hindsight, an $8 billion funding package for additional money to go to the CDC and to make testing available. March 18th, another $100 billion, which again seemed big at the time, with free coronavirus testing. And some unemployment insurance benefits expanded. But the big one was 2 weeks ago when the Congress passed Phase 3, which is known as the CARES Act. It provided fully $2.2 trillion of support to small businesses, expanding on insurance benefits, to a bailout for the airline and cruise industry, and a lot of money going directly to municipalities, state and local governments, and hospitals to gear up for the potential coming hospitalization crisis should we be unable to contain the coronavirus, which, by the way, there seems to be good news on that, and I'll talk about that in a second. But the idea that the federal government brought both of their big players to the table and said, we're going to fix this thing. We're going to bring monetary policy to the table immediately. Because the Fed is independent, it could act first. And then through a bipartisan agreement in Congress and signed by the administration, we were able to get on the order of $2.5 trillion worth of fiscal stimulus ready to go. Is it enough? The answer is almost, it doesn't matter, because if it isn't, then there is a great deal of political will in Washington, D.C. today to do more. If it's not enough, they're going to do more. Why is that? Back in 2008 and 2009, there was a villain it was the greedy banks and Wall Street that you could pin the troubles of the economy on. It was a credit crisis born out of Wall Street. Well, this clearly is not that. I mentioned earlier, this is the first ever government decreed recession. It's a loss of aggregate income through nobody's fault, not through greed, not through poor business decisions, but the government shut down the economy by decree in order to contain a severe national health crisis. And as a result, no one's to blame. It makes it easier for politicians in Washington, D.C. to articulate and craft and then implement a massive fiscal stimulus plan, overcoming very little objection, if any, because there's no villain on the other side. It's just, it came out of the blue, a black swan, an unforeseen event that doesn't have, a bad guy. So that's the good news. If the 2.5 trillion or so that's been already earmarked for economic mitigation issues isn't enough, the government will do more. We toss around numbers like trillion. I just want to highlight that's a million, by the way, on the left. That's a billion on the right. That's a pallet full of $100 bills. That's what a billion and a million looks like. If you want to see what a trillion looks like, just to get a handle on the size, that's a trillion. And there's your little guy over in the bottom left-hand corner there for reference in terms of trying to get a sense of what that means. A trillion is a lot of money. It's a huge amount of money. It's 5% of the U.S. economy. A $2.5 or $3 trillion stimulus package means 15-20% ultimately. We could get to 20% of the U.S. economy in terms of stimulus. That would be absolutely amazing. Let's talk about what happened in 2008 and how does it compare to 2020. So back in 2008, you had a 55%, 56% drop in the S&P 500. And it took 4 years to get back to the levels that we saw at the peak in 2007. And you needed a 128% recovery to get back to where we were. How does that differ from 2020? Well, again, we were up about 40% from December of 2018, which was the last bout of volatility. And we had this almost rocket ride straight up to the peak, which occurred on March 23rd. That was a 44% gain. We had 33% decline and a 24% loss. So ultimately, the peak to trough of 2020 has been about 60% of the peak to trough we saw back in 2008. And the recovery seems to be moving more swiftly as well. What can account for that? Well, let's talk about that. It's because the Federal Reserve already had the playbook in mind. This is from a presentation I gave back in June of 2008, and it's all of the same alphabet soup and programs that the Federal Reserve brought out in 2008 and 2009 to try and fix the credit market. So the Federal Reserve knew what it was that they were supposed to do. And here's the timeline from a presentation that I gave in June of 2009. And I just want to highlight this fact that A, the Federal Reserve knew what to do, and B, they brought it to much more quickly. They brought their A game and all of the ability to soothe the credit markets. Instead of waiting 3 or 4 months and having to go through the process of creating the alphabet soup of lending facilities, they already knew that the first thing they had to do was to reduce interest rates to zero. The second thing they had to do was to expand the balance sheet. And the third thing they had to do was create all these lending facilities to put out the fires that were being created in various pockets of the bond market. Instead of it taking 5 months for the Fed to do all that, they did it in 2 weeks. And that's why we're seeing such a substantial and swift recovery. It was the fastest decline from a peak to trough into a bear market that we've ever seen in post-World War II history. It's also been the fastest recovery that we've seen. And the reason for it has been the swift, timely response from the Federal Reserve. You may ask, what is all this debt we're taking on in terms of the fiscal stimulus and the money printing that's coming out of the Federal Reserve? What does it ultimately mean? Is there any limit to it? And the answer is there is. The limiting factor will ultimately be inflation. But right now, these are inflation measures on the left. We're well below, not well, but we're below the Fed's 2% target for the inflation measure that they care most about, which is the US PCE core. That's the blue one. And we've been much lower recently. And on average, not since the great financial crisis have we been anywhere near the Fed's 2% target on PCE, except for a very brief period at the beginning of 2008 when the Fed started to make noise about actually raising rates, and then didn't. Did a couple times and then lowered rates rather dramatically thereafter, and now we're of course back down to zero. The point I want to make is inflation is not a current problem. The market doesn't think so either. These are market observable measures of inflation expectations. And what this number here means is that right now the market is suggesting that inflation for the next 5 years is going to be less than 1% at 88 basis points. And inflation in years 6 through 10, looking out from 2026 to 2030, inflation is going to average 1.33%. So right now, the market's telling you that inflation is absolutely not a problem. But in the long run, there is a limit to money printing and to taking on debt. So let's talk a little bit about where we go from here. I don't think there's any chance that we can wait for a vaccine or herd immunity before we can restart the economy. The economy is likely to be reopened in a rolling basis over the course of the next couple of months, and we're not going to probably get back completely to normal for a year or maybe more. But the idea that we can open a good measure of the economy by the end of the third quarter, I think, is a pretty good bet. Need a lot more testing, however. You've got to be able to test before any of you are going to send your kids back to school, or before anyone feels comfortable here in Chicago getting on a subway or getting on a train and going back to work. It's a little different in California because you've got the ability to commute without getting into a confined space with a lot of folks. We're going to need masks. We're going to need masks and other personal protective equipment before we can do a rolling reopen of the U.S. economy. And when we do start opening the economy, it's going to be more of a U as opposed to a V. Sometimes the equity market is telling you that we're going to have a V recovery, and I'm not so sure that seems a little optimistic to me, given all of the questions that people are asking, like when is it going to be safe to go outside, and when is it going to be safe to go back to a restaurant, and do I really want to go back to a restaurant and be served by someone who has a mask and gloves on? And the answer is, I think we're going to find out probably later in the second quarter and into the third quarter. But again, for me, that just means there's a lot of questions and not a lot of answers right now. This is the key point I want to make as it relates to reopening the economy. As we begin to do so, we just have to be cognizant of the fact that while we don't all yet have any kind of a herd immunity, that means you could see flare-ups. You could see flare-ups and a return of the virus. And when you do, you just really need to be aware of the absolute limits of healthcare infrastructure and what resources are available locally. That is, we should reopen the economy, and we can. And the only reason to pull back on that project would be once we get to a point where we're seeing that the number of ICU beds are being filled up and there's not enough reserve and not enough margin of safety, and that the potential for the local healthcare infrastructure to be overwhelmed is getting to be a higher probability. So there is I think a thoughtful way to do this. We can take care of the virus and take care of people that get sick, and also take care of the folks that are healthy and can go back to work, as long as we keep a very close eye on the limits of the local healthcare infrastructure. So that means having more ICU beds available, having more ventilators available, an immediate increase in the number of masks, particularly the N95 masks and the PPEs that are required for healthcare workers to do their jobs. And I think we're a little behind on that. So it's going to take testing and masks, and then we can start to reopen the economy so that when there are flare-ups, we have both the testing and the contact tracing infrastructure available to make sure that we can damp it down, keep the economy open, and make sure we don't overcome the infrastructure. How can you do that? And there's a lot of information out there. I'm just going to quickly check out a website called COVID-19healthdata.org. Here's California's, here's the situation in California. What do you need to do? This is, frankly, the number of ICU beds available in California is 1,900. The number of ICU beds needed right now is only 465. That's this green line, by the way. ICU beds maximum, 19, this is 19, it's called 2,000. The beds needed right now, you can't even see the little green dot, it's well below. The scale is huge. So as long as we can keep a projected number, and this is the chart of projected new beds that are needed. By the way, total new beds available, 26,000, way at the top of the list here. So California is actually in very good shape, in large part for some of the reasons I mentioned before. New York, Chicago, other places have high density business districts, and it's just a fact that folks that are closer together, particularly commuting or working, there's going to be more instances. I expect California to be one of the first countries to open up. Right now, this is the projection as of tomorrow, April 18th, and you can see that the number of total beds in the confidence interval here never gets anywhere near close to the number of hospital beds that are available in California. The point is, this is the limiting factor reopening the economy. As long as we can keep this curve well below the capacities of both the total beds, the ICU beds, and the number of ventilators, then we should be able to open the economy in a thoughtful way, a careful way, and in a way that fulfills the two imperatives, which are take care of the people who are getting sick with the high quality medical infrastructure that we have here in the United States, and take care of the people who have the virus or who won't get sick, or if they do get sick, they will have limited impact. Let's get them back to work and get the economy moving again. I think we're gonna see more and more talk about how this is the framework for how you reopen the economy. It's just be aware of the maximum capacity, the local healthcare infrastructure, and with testing and PPE, you'll be able to move forward. So I just want to sum up a few comments here and then talk about what some of our managers, some of the other folks that we're talking to are saying about this. We're experimenting here. This is an absolutely new system. All the economists I talk to, and we do have a lot of contacts that we're speaking with on a pretty regular basis about how all of this is going to affect the economy going forward. We're all in general agreement on this. Here in the United States, we are able to mount the most aggressive response because we are the reserve currency of the world and because U.S. Treasuries and our markets here are viewed as safe havens. What does that mean? That gives the United States almost unlimited debt capacity. It's not completely unlimited. As we talked about, inflation is a limiting factor. But right now, in the U.S., we have the ability to print money and to issue debt. We could, in time, see a return of inflation, and we could also see, and this is in the limit, a loss or a reduction in our ability to see trade in the U.S. dollar, which means we wouldn't be the reserve currency anymore. Right now, most goods globally are traded in the U.S. dollar, and as a result, the U.S. retains what's called reserve currency status. That's a huge benefit. The ability to be the reserve currency brings huge benefits to us, both in terms of a concept called seniorage, which means we can print money and monetize things and do things that other countries that don't have reserve currency status can. So our safe haven, being viewed as a safe haven and being viewed as a reserve currency, which are linked, gives us, as I mentioned, unlimited debt capacity. But it does also mean that we're going to blow up the budget, particularly this year. The entire $2+ trillion in the CARES Act is going to be funded through new debt issuance. So our budget for 2020 is going to be at least 2 or 3 trillion wider in terms of a budget deficit than we had before. 2 ways to close a budget deficit. You reduce services, which is not on offer right now, or ultimately you raise taxes, which tends to reduce future growth. So we're going to blow up the debt. We're going to have a much higher debt to GDP ratio here in the United States. It's about 85% right now. It's going to be over 100 in the next 2 years if we don't change the debt sustainability factors, which means if we don't get the budget deficit under control very quickly and actually run a budget surplus for a period of time, it's not clear that we would be able to stop the growth in debt to GDP. So what's the problem with having high debt to GDP? You might say Japan has 250% debt to GDP, and they've had that kind of a ratio for the last 15 or 20 years, and they've also seen very little growth. Italy is another country with very high debt to GDP. It's 140%. Greece had about 160% debt to GDP back in 2011, 2012 during their crisis. So those are the highest debt to GDP countries. That's not great company for us to be moving towards, but it's what we need to do. It's what having debt capacity is for a crisis. So we're using our debt capacity, but that doesn't mean that 5 years from now or 10 years from now, we won't still be feeling the effects of the explosion in the budget deficit. What do you do when you have a huge debt to GDP ratio? The answer is there's only three ways to reduce your debt burden. One is to pay it down. That means higher GDP for government debt. So normal debt service. That's great for the bondholder. If you're a Treasury bondholder, what you want is for the US government to be able to continue to generate tax revenues, and pay down the debt. That's choice number one. Choice number two is you inflate away the debt burden. You inflate away the debt. I'll come back to that because choice number three is not even on the table. Choice number three is you default on the debt, and the US doesn't default on its debt. So choice number two is inflating away the real debt burden. Let me talk about what that means. It's really just another way of saying we'll be in my view, for a period of extended financial repression. And financial repression is not bad. And risk assets can do well in a period of financial repression. Let me define that, by the way. Financial repression means that the federal government, through the Federal Reserve primarily, will keep a lid on nominal interest rates. And if they have to, the Treasury will actually come out and cap interest rates. And the government can do that with varying degrees of success. That is, we're just not going to have bond yields above 2%. Right now, they're below 1%, but the government could say it would be very difficult for us to service our large debt burden by continuously issuing new debt to pay off the old debt at much higher rates. So we're just going to cap rates and keep them low so that we can manage the debt service payments on this 120% of debt to GDP, this ballooning debt that we've taken on as a necessary mitigator of the COVID recession. So low nominal interest rates are first. Then you try and engender some inflation. So what's the Federal Reserve doing right now? The Federal Reserve is printing money hand over fist. So it will ultimately result in some inflation. And when it does, you'll have a combination of low nominal interest rates and higher than expected inflation. And as a result, over time, you will reduce the real debt burden in the economy. Think about this for a second. You've got all this debt that you've issued in 2019 and for the 20 years before that. Now you've got, in the future, higher inflation, which means you're generating tax revenues at inflated dollars, and you're taking those inflated dollars and you're paying back debt that you issued in the years prior. So as combining those two things, having a relatively low nominal debt burden from before and then paying it off with much higher inflated US dollars in the future, that is very, very positive. It's called inflating away the real debt burden. You're reducing the real debt burden. That's all financial repression is. It's a way to deal with incredibly large and oversized debts. So that's what we expect going forward. So let me finish up here, and then I'll answer some of the questions that folks submitted to India and to Julia. Right now, it really makes a lot of sense, I think, to sit tight. You've seen a lot of response, fiscal and monetary response from the administration, Congress, and the Federal Reserve. That's the cavalry. They've arrived, but we're not through this yet. Most of the bad news from an economic perspective hasn't even been printed yet. But there's a lot of bad news included in the current economic environment. So, and in the equity price with the S&P at 2750 or 2800. So the cavalry's arrived, but I don't think we're through it. What are the themes that we're exploring at Beacon Point? And I think they can be summarized here. When the passive equity index investing phenomena accelerated since the great financial crisis, it had a couple of positive and maybe one or two negative implications. Passive investing has a place in almost everyone's portfolio. So does active investment. And in fact, when volatility increases, active investment can play a more important role in a client's portfolio because volatility gives an active manager the opportunity to outperform. So what we've seen with a lot of indiscriminate selling of what I would call passive investments in the S&P 500, not all the companies in the S&P 500 deserve to be sold, but because folks, in any case, held them in an ETF, a passively managed index ETF, those companies got sold right along with the companies that might not make it through the next couple of quarters as well as companies in either the tech or the healthcare, or in some cases, consumer discretionary. So when people were trying to sell and reduce risk by selling down equity ETFs, the thing to do maybe there would be to actually rotate into a more active management style. Give the manager the ability to sift through some of the babies that have been thrown out with the bathwater, as they say, and sift through the wreckage and find the good equities and find the good companies and put those in the portfolio. So if you're a passive investor or have some passive in the portfolio, that you've done well and it's a good thing. Might be time to consider adding a little active equity exposure to the portfolio. And there's a couple of ideas I'll talk about in a second. We talked a lot about how there was volatility in the marketplace, frankly, volatility in the bond market, and cracks and dislocations in places like U.S. Treasury securities, U.S. investment grade, and U.S. high yield corporate bonds, and in municipal bonds. And when you have this type of environment and liquidity is scarce, it's to the investor's benefit to be a liquidity provider. What I mean by that is, in the markets like municipal bonds and corporate bonds that have seen massive dislocations and widening of credit spreads and widening of what we call the bid-ask spread, that is, transaction costs are high because everyone is heading for the exits, being on the other side of that and controlling for the emotion of wanting to join the herd and to join the crowd and to sell things that you feel are risky. If you can put that aside, if you can try and control that urge and be a liquidity provider, the sellers are liquidity takers. You want to be a liquidity provider because it's really inexpensive to provide liquidity. That means there are opportunities for clients that are willing to look at things beyond the initial emotional reaction and maybe get involved in places like investment grade corporate bonds and municipal bonds at firms like Belhaven, where we have a very long-standing relationship, and many of you likely have a Belhaven portfolio. Matt Dalton's the portfolio manager there. I talk to him very regularly. His philosophy and process is well suited for the current environment, and he is doing what I've just recommended clients do with active managers and equity, and that is he's sifting through some of the municipalities and state and local governments to find the municipal bonds that are getting thrown out while everyone is hitting the sell everything button. He's in a great place to see that flow of bond trading activity and to selectively add to the portfolios. And I've told clients almost consistently since the beginning of the crisis, it's really important to just get out there and look and see what's happening, and realize that not everything is the world's not coming to an end. The U.S. economy is absolutely a going concern, and as a result, the state and local municipalities are a going concern. So municipal bonds, which have very low default rates historically, and when they're trading at yields well above Treasury securities, that's an indication that, and that means that the after-tax yield is even that much more attractive, right? Municipal bonds look spectacular. I also like investment-grade corporate bonds in certain circumstances, and in fact, for clients that do have a little bit of extra risk budget and aren't fully invested already, there are opportunities to even go slightly below investment grade into high-yield corporate bonds that seem to make some sense. And in fact, if you've got a longer-term time horizon, and I hope all of you do, and you can give up a little bit of liquidity, you can provide liquidity in two ways. In the short run, by buying dislocated markets like municipal bonds and investment-grade corporates, and you can provide liquidity in another way by investing in private investments, private alternative investments that have liquidity constraints. So you're getting paid a liquidity premium to lock your funds up for anywhere between 2 and 8 years, but you also achieve a substantially greater yield for those type of investments because you are effectively providing liquidity in a market that is liquidity starved. So just to bring this all back to the beginning when talking about the Federal Reserve and about investment opportunities, you're effectively doing what the Fed's doing. You're standing alongside the Fed. You're providing liquidity. You're buying things that are dislocated. And the one thing I learned back in 2008 and 2009 is that you should always buy what the government's buying. That's a good strategy in almost any environment. Just a couple of quick notes on what some of our investment managers are saying. So we work with a lot of really high quality equity and fixed income investment managers. Pollin Capital and Morgan Dempsey are two. Pollin is a great firm for seeking out companies that aren't what we call that can fund themselves without access. They don't need access to outside or public credit. They don't have a lot of debt on their balance sheets. They don't need access to the corporate bond market. So they are what I call the better balance sheets. That's Pollin Capital, their approach, and it's frankly well suited for the current environment. The other item that might be of interest is if interest rates are going to remain low for a long time, and we talked about the idea that financial repression is almost inevitably the environment that we're going to find ourselves in coming quarters. Financial repression argues for lower nominal interest rates, and for folks that need income and want to increase the ability to generate income through dividends, Morgan Dempsey is a great choice there. So they focus on the higher than average dividend payers because they will and have historically performed better in a low interest rate environment, and that's what we're predicting. So let me move on to bonds. I talked a lot about Belhaven already, and this is just a chart that suggests that currently municipal bond yields versus U.S. Treasury yields, rarely, if ever, do you see Treasury yields. This is the purple line on both of these charts. Here's munis you'd buy in a client portfolio that you're looking to show some taxes. These are taxable munis over here. It's a little different asset class, but it's analogous to the tax exempt muni market, which is represented by this green curve. This is amazing to be able to, and this is a maturity, years of maturity on the horizontal axis, and the yield you can get on the vertical axis. So just a 10-year municipal bond, for example, yields about 225 right now. Oops, let me go back to that slide. And there's no need to go out here, I don't think, much to reach for 3% yields in this environment. May not make sense, but a 10-year muni at 2.5% at the same time that a 10-year treasury is yielding 75 basis points. And remember, you're going to be taxed on the income from a treasury security, so the taxable equivalent yield on treasuries is about 25 basis points lower. So comparing apples to apples on an after-tax basis, munis make a ton of sense, and they don't have a lot of defaults. I mentioned earlier that what you see in municipals is it's a less liquid market. It's dominated in many cases by individuals and not institutions, and as a result, it reacts differently. Even though there are some comparisons to the investment grade corporate bond market and the municipal bond market, they have some very distinct differences that can work to the advantage of an investor during dislocated times like now. So what you're seeing, I think, in the municipal bond market is a mark-to-market problem. It's a liquidity concern, not a solvency concern. That is, every single day, bond managers are required to mark their portfolios to that existing market. And if people are selling municipal bonds indiscriminately, then the price will decline, even if it doesn't reflect a decline in their solvency or creditworthiness. So what you're seeing is an accounting issue where bonds are being marked 4, 5, 6, or 7 points below where they should trade if they were trading on the fundamental default risk that municipal bonds typically have. So this is an excellent example of a dislocated market. It's a market that we like for clients. We like for clients that have cash to invest. Municipal bonds at 2% is not an opportunity that's going to last, and it fits into our broader theme of buying what the government buys. So again, looking broadly, we like the U.S. versus international because the U.S. has more degrees of freedom to fix the global economic issues. We like growth and value. It's really more active versus passive. Passive has a place. Active has a place in the current environment. Growth we like because it looks like interest rates are going to stay low, and the growth companies will benefit from the new normal that we seem to be heading towards. So tech companies, consumer discretionary, and other type of growth companies, healthcare, particularly pharma as opposed to hospitals, seem to be doing really well. On the other hand, there are some value opportunities that are likely to do better, especially in the recovery. Banks will do better as the economy and credit markets heal. They've had a tough go. So there are opportunities in both growth and value. I think the idea there is to be selective, and if you have the opportunity to reduce a passive investment and look at a more active manager, that's what I'm saying with growth and value. Specifically within equities, dividend-paying equities look a whole lot better than government bonds, which yield 75 basis points or less than 1%. Government bonds, which have an excellent role to play is a insurance against a recession, have played out. It's time to cash in the insurance and move on to either municipal bonds or into high dividend paying stocks if you do have a treasury investment, because treasuries don't really have very much scope to move lower, which is what you need to have capital gains in treasury securities. As interest rates rise, treasury securities don't have a buffer. They're going to see capital losses. I don't expect, and we don't expect, that treasury securities and treasury rates are going to rise terribly quickly, but should they do so, they will suffer. They've been the best place to be year to date because they're insurance against a recession, and we're in a very difficult economic environment right now. But now that we've had the recession, it's time to move into something else. Again, what are those things? Dislocated markets, U.S. securitized, U.S. corporate bonds. Securitized are mortgage-backed securities, asset-backed securities, things that are backed by credit cards, auto loans, things of that nature. Those are all dislocated, just like corporates and munis, which we've spent more time talking about. EMD is emerging market debt. Emerging markets don't have, again, the scope or the ability to respond to their economic challenges, and frankly, they suffer with low oil prices. So there's a couple of things that make EMD not a strong case right now, but that over time, emerging market debt is a pretty good place to be. I put a question mark on it because we're just not there yet. And in the future, and I put it out into the future, TIPS and real assets, as inflation becomes a potential problem during a period of financial repression, seems like a pretty good thing to start to be thinking about now. So remember this: global central banks have your back, and as a thesis for investing, buy what the government buys. If the government's buying it, it's probably going to do okay. And I think in times like these, what we have to think about is the fact that while it seems like a pretty dark environment that we're finding ourselves in, know that the federal government's response has been absolutely extraordinary. And we're not exactly sure when we're going to fully contain the virus, and we're not fully sure what the total damage to the economy has been. But it's entirely likely to me that that once we tote it all up, that the government will have done what they needed to do. That is, that the U.S. economy is a going concern. So don't forget, global central banks have your back. Buy what the government's buying. I'm going to stop right there and see if there's other questions that were posed that I didn't touch on during the course of the presentation, and take this opportunity to suggest that if there was something I didn't cover that you want me to go into more depth on, please don't hesitate to contact India and Julia. They can reach me directly, and I will get right back to you. There was a comment or a question about during the 2008 crisis, we had a lot of ups and downs, and do we expect another dip? The answer is there's a lot of things that make 2008 and 2009 very similar to 2020, as we've discussed, but there's a lot of things that are different. And given that this is more of a biological or scientific issue, that is the containment of the virus that will help us to understand when we can get back to work, and not a financial crisis born out of the mortgage market, which you knew was going to take a long time to fix. This actually kind of has an end date. The end date is a vaccine or full herd immunity here in the United States. So there's a lot of uncertainty about the vaccine and treatments. There's a lot of uncertainty about when we can reopen the economy. I've articulated a potential metric to use in order to reopen the economy. I think it's the right one, but because of the uncertainty surrounding the virus, you just can't know. I thought a week or 2 weeks ago now, that we were in a typical bear market rally. After the market had recovered 15 or 18% and getting back to almost a bull market again, I thought this is what you see. You see markets selling off. You see a 50% retracement, and then maybe a 68% retracement, and then you have a pullback, and it's kind of a choppy market for a while. So I wouldn't be surprised if we get that. And if we do, then some of the things we suggested in terms of getting involved in providing liquidity and looking at active equity management will likely benefit the portfolios in that environment. Someone asked about inflation, not for a long time, but it is the inevitable result. And frankly, we mentioned it's the limiting factor on all of this debt and monetary policy provision that we've seen. So inflation, not a problem yet, but as I've indicated on this chart, it's going to be an issue. It's something that you want to talk about with your financial advisor. Know this: we are laser beam focused on when the turning point of inflation might be. And we have the tools available to protect the purchasing power of the portfolio. And you'll hear all about them from your advisor as we move in that direction. But that's quarters and perhaps years away, given the size of the effort here to fix the U.S. economy, and the fact that the bottlenecks aren't likely to be evident that would cause inflation. They're not likely to be evident anytime soon. Talked a little about emerging markets. I'll just reiterate, we have the best opportunity to fix the economy here in the United States because of our reserve currency status. Don't forget that. That absolutely informs our view that we should be overweighting the U.S. versus international, at least this quarter. We just completed our macroeconomic and asset allocation meetings and are compiling the results now. But here's a quick preview. We're going to be overweight U.S. stocks versus international stocks for the very reasons that we discussed today. Value versus growth. Value has done very poorly, and will have its day again. But a lot of folks have died on that thesis and on that forecast in what's called a value trap. So value growth does really well because the cash flows to a growth equity come in the future, and with low interest rates, that isn't such a burden to overcome. Value companies typically have a more steady cash flow projection in the front years. So growth stocks do well in low interest rate environments just because of a discounted cash flow, just because of the mathematics associated with discounted cash flow. Our view is that we're going to get lower for longer. When interest rates start to rise, that's when value will likely outperform significantly growth. But there's a lot going on there, and I just want to caution clients that when looking at growth versus value, the composition of those indices have changed dramatically. 10 years ago, there was no such thing as Fang, and now each of the Fang stocks are 5% of the index. So it's really hard to say when growth and value will equilibrate or return to norm, because the indices, composition of the indices is so very different. Again, another argument potentially for taking a good look at some of the active managers that are part of our lineup. Talked a lot about municipal bonds. So here's what's happening, and here's what I think is going to happen, and then I'll turn it back over to India for any final comments she may have. Municipal bonds, I think, are representative of most of the market. At the end of February, beginning of March, and right up until March 23rd, I think most investors were terribly concerned about what the future held. And as human beings, we are almost always inclined to do something, something proactive. And in many cases, as it relates to portfolio management, that actually means selling things. So a lot of folks did, and many markets are dislocated as a result. So the municipal bond market is going to heal. The thing to think about isn't how bad it is today. The thing to think about is what's the government doing, and what are the possible outcomes that would cause these markets to normalize. And I think I would conclude by saying that the federal government's doing everything that they possibly can. They're going to fix the municipal bond market. Munis are going to be just fine. They're one of our better ideas right now. corporate bond market is going to do well. The equity market will follow the course of corporate profits, which, if we get the economy reopened in a timely fashion, are likely to rebound. And in fact, the market seems to be looking through the fact that there will be a severe hit to corporate earnings for the coming quarters, and is likely to price in 2021 earnings instead of 2020 earnings. So it's not all bad. And in fact, I believe that markets like these create opportunities for thoughtful investors and for clients that that are willing to listen to their advisors and to have an open mind about where some of these assets are going. It's actually a pretty good time to be a long-term investor. With that, India, I'll turn it back over to you and see if there's any final comments you want to make, or if there's any questions that I missed that you want to make sure I address for this group.
Absolutely. I appreciate it, Michael, and thank you so much. We do, and I think we're going to have quite a few other questions, but to your point, Julia and I are here to help you, all the clients, and to get you the information that you need. So please don't hesitate to reach out. The other thing I just wanted to mention is that a lot of what we've talked about today is already happening in your portfolios. Many of you have a Belhaven account, you have a Pollin account, you have a Morgan Dempsey account, you have another one of our active managers. There's always elements of active and behind the scenes, day to day. You know, you have the brightest brains possible on the front lines doing exactly what Michael talked about today, which is sifting through the wreckage and picking out those companies that are going to do better in this environment than others. And then on top of that, Julia and I have been working, you know, to do things that are opportunistic in this environment, whether that is tax loss harvesting or creating losses for tax purposes, whether that's increasing active in the portfolios. So please don't hesitate to reach out to us with any questions on that side of things. But this is a great kind of overview. And so thank you, Michael, in terms of how we think and why we do what we do. And just another, some insight to some of the other brains we have behind the scenes. So hopefully you all enjoyed today. Thank you again.
Thank you, India. Thank you to all the participants. And yes, please don't hesitate to reach out if there's any more we can do. Thank you, India. Thank you, Julia, for having me. Take care.
Thanks, Michael.